ABC Company still has a few ratios to go through. The first one is debt ratio. And debt ratio is essentially a measure of how much of the assets that you own are still being financed with debt. I mean, you can say you own a $500,000 house, but if you owe the bank $495,000 on it, you don't really owe much of it. Same concept here. What portion of all of our assets do we wholly own, like are ours, and what portion of them are we still paying on? The formula for debt ratio is just total liabilities divided by total assets. So for 2021, I hit equals, I go to my balance sheet, and I find that total liabilities were $132,000 in 2021. Our total assets were $330,000 in 2021. That is a debt ratio of 0.40. So essentially for ABC Company in the 2021 business year, 40% of what they own, they still owe on. It's still being financed by debt. How does that compare to 2020? Well, we go hit equals, we go back to our comparative balance sheet. We take 2020's total liabilities of $115,000. Divide that by the $300,000 of total assets that they had during the year, and that comes out to be 0.38. So last year, only 38% of our assets are being financed by debt. We're getting a little deeper in debt financing here, but we're still well below the industry average. To be of similar risk to our competitors, to other companies in the industry, we could still afford to take on more debt if we wanted to use that to finance future activities. Another ratio helping you decide whether it's a good idea or a bad idea to take on more debt is your debt to equity ratio. For all of the things that we have, that we acquire, there's really only two ways we can pay for it. We can take out a loan, we can finance by debt, or we can finance by equity. And equity has two components. We can either issue shares of stock, common stock probably, to raise money, or we can be profitable and retain some of those earnings. So debt to equity ratio is basically a measure of how much of your financing is coming from debt versus what is coming from equity. And it is just total liabilities divided by total equity. So if I go back to my comparative balance sheet in 2021, our total liabilities were $132,000 that year. Let's divide that by our total equity for the year, which was $198,000, and we get 0.67. So our liabilities were 2/3 of what our equity was that year. We were financing more with equity than we were liabilities, more with equity than we were debt. How does that compare to the year prior? Well, in the year prior, back to our balance sheet, we had total liabilities of $115,000 versus $185,000 in total stockholders' equity. That was 0.62. So this is just reaffirmation of what we had in the prior ratio. Yes, our financing model has gotten a little bit more towards debt than it was equity this year, but we're still like less than half debt financed compared to other companies. Every other company in the industry is financing $1.45 worth of purchases with debt for every $1 of equity they're purchasing. So we have here confirmed that we definitely have the ability to take on more debt to finance operations. We are very good at holding on to cash. We're very good at turning the thing that we do into cash. We're not riddled with debt. Everything sounds good as long as we are a hugely profitable company. Are we? That's what we have gross profit percentage and profit margin ratio for. Gross profit percentage, you can see that up here on the top, is gross profit divided by sales revenue. So let's go to 2021. We're only going to do 1 year for comparison here against industry average. Take our gross profit from 2021 from our income statement, divide it by the sales revenue reported on the income statement. And in our income statement, we had gross profit of $240,000 divided by sales revenue of $1 million. Essentially, 24 cents out of every sales dollar that we had was left over after we accounted for the cost of producing or selling that inventory. The industry average is 38 cents. So we're not making as much profit off of the sale of goods, accounting for only the cost of those goods that we're selling, as everybody else in our industry. Well, what about overall after we account for all of our expenses that we have to pay? That is our profit margin ratio. So we take our net income and we divide it by sales revenue. We hit equals, go back to the income statement, find my net income, which was $30,000 for the year, and divide it by our sales revenue. we come up with 0.03, which means for every dollar of sales that we did, we made about 3 cents of income. Everybody else in our industry, for every dollar of sales they do, they make about 9 cents of income. We're not as good as everybody else at turning the stuff that we do, the goods that we sell, into actual profit. So yeah, we are not deeply in debt, and we're very good at collecting cash, and we have a lot of cash on hand right now. But that doesn't change the fact that we're not very good at turning our actual sales into profitability. Maybe we want to use some of that excess cash we have. Maybe we want to take on some more debt in order to design new products, which might be more profitable for us, or increase our selling price on here and then put out advertisement campaigns to make people want to have our total product offering, our products, encourage them to buy at a higher price, which will hopefully increase our overall profitability. But for as good as we are in all of the above things that we calculated, ABC Company is not good at turning sales revenue into profitability. What do our shareholders think about that? We have two metrics here to wrap this thing up, and they are earnings per share and price to earnings ratio. Earnings per share is a measure of, hypothetically, if you took all of your income for the period, you didn't retain any of it, you distributed all of your profit for the period to all of your different shareholders, how much money each shareholder would get for each share that they owned. And EPS, according to our information page up here, is just net income minus preferred dividends, because EPS is only for common shareholders, divided by the weighted average shares outstanding. How many shares on average of your common stock you had out in the hands of the public during the period. Well, net income we know we're going to find off the income statement. What about preferred dividends and weighted average shares outstanding? That is provided up above. We don't have any preferred dividends, so ABC Company must not have preferred stock. Weighted average shares outstanding for the year was 100,000, so I can just go and fill in that formula. We're going to take our net income, which on our income statement was 30,000. We are going to subtract from that our $0 of preferred dividends. And we're going to divide those two numbers, which I put them in parentheses, so Excel would subtract that out first. We're going to divide that by our weighted average shares outstanding. Since we don't have any preferred dividends, if we distributed $30,000 of income equally amongst our 100,000 shares that are out there, each owner would get 30 cents for each share that they owned. For other companies in our industry, if they did the same thing, their shareholders would get $1.10, which means their stock looks much more, I guess appetizing is not the best term, but it looks like a better investment to shareholders of another company than ours, because we have a very low EPS. Well, what about price earnings? Price earnings is a measure of how much money shareholders would have to pay to get at $1 of your company's earnings. The formula for it we have up here is the market price of common shares divided by our earnings per share. Well, let's go down into the cell down here. Let's hit equals. That market price of your stock at the end of the year is listed here was $6.25. Our earnings per share we just calculated was 30 cents. So if you take $6.25 and you divide it by 30 cents, you come up with 20.83. And what that means is that people would have to spend $20.83 to get at $1 of your company's earnings. The industry average is 28.20, and I know it's natural reaction to be like, oh, ours is lower price is better. Well, no, not what we're saying here is this is how much we can raise in funds from selling stock. This is how much we can sell our stock for every dollar that we make. We want that to be as high as possible. We want to make as much money as we possibly can off of future stock issuance. So from the company's perspective, price to earnings is lower than the industry average, and that's not great for us. So I think ABC Company's shareholders or potential shareholders have looked at all of our metrics, and they're feeling pretty good about all the stuff that we have up front. We're not deep in debt. We got quite a bit of cash on hand. But they've looked at the fact that we're not turning a whole lot of profit off of each sales dollar. Nor do we have are they going to be able to get a lot of our earnings for each share that they buy, and they've decided we're not going to pay as much for it as we would if you were making more money. So ABC Company, as good as they are in all of the balance sheet ratios, needs to find a way to improve their profitability.